Okay, new whiteboard video. This one is called Confessions of a Private Money Lender. It'll mostly focus on the financial and monetary aspects of a Bitcoin standard, but it will be a little bit of a spicy take because I actually think a Bitcoin standard would fail to live up to expectations because of things like shadow banking. Towards the end of the video, I'll describe some solutions to what I feel the shadow banking problem is, and then I will also discuss high level why I think things like Lightning Network and ARC and RGB and Fedimints are probably not viable solutions to solve this problem, but why ZK Rollups is kind of the emerging tech that could do the trick. If you want a quick summary, because you don't want to watch the whole video, it essentially comes down to a lot of the concepts that we talk about, like fractional reserve lending and central banking, really are not as relevant to today's financial world as most Bitcoiners would have you think. And in actuality, a lot of the credit and the leverage in the economy is created by the private sector. And it's done using tools like securitization and collateral intermediation. And these are methods and ways to create leverage, extreme exorbitant amounts of it, without actually changing or impacting the money supply. And so because of that, it means that even if we get to this hyper-Bitcoinized world where we only have 21 million Bitcoins and we can all trustlessly send it back and forth to each other, you're not removing the ability, and probably more importantly, you're not removing the incentive for financial actors to perform these leveraged financial games in the shadows, which can kind of fester and eventually go bust after a decade. But if we can recreate these financial applications and do it in a way where they're cheaper and they're faster and they're more scalable and they're more cross-composable and they have deeper liquidity, then you can essentially take all of that activity which exists in the shadows and you can pull it onto these kind of transparent and fully auditable ledgers. And for me, that is ultimately the kind of like great grand vision that I hope for, that you kind of acknowledge that these financial applications, these things that happen in the shadows actually do in fact serve a function, but you need a way to kind of keep them responsible so that they don't tear down the financial system because nobody could see it coming. All right, so the final thing that I just want to describe before we hop into the whiteboard is I call this Confessions of a Private Money Lender because, you know, I used to run a private money fund. It is something that I started and I built from scratch and I actually sold a couple of years ago. And while I was managing that fund, while I was running it, I was learning about things like shadow banking and Eurodollars and repo and collateral. And there were moments where I was learning about that where I was like, holy shit, you know, like a lot of this stuff that they're talking about, like this is basically just what I do in my day-to-day life. So I felt kind of seen when I was learning about it. But you know, I'm not some heir to the Rothschild central banking cartel. I'm not some shadowy fractional reserve lender. I was just, you know, a guy, a businessman that was pursuing, you know, my rational self-interest and following what I felt were my incentives. So if I was doing that in today's economy and it was kind of creating these economic distortions and this financialization, then why would myself or someone else not also do that on a Bitcoin standard? And so a lot of this video will kind of explore that and work through and say like, okay, is some of this stuff going to exist on a Bitcoin standard? With that, okay, we can now finally hop into the whiteboard video. Similar to my other video, a lot of this is kind of blank. As we go, we'll talk through it and we'll fill it all in. It'll start off by describing, you know, how some of these financial games work in today's modern economy, and then very easily we'll show how it can translate into a Bitcoin standard. All right, so let's get started. As I mentioned, you know, I used to run a private money fund, so we'll just call this fund right here. I had private individual investors that would invest cash into the fund, and then we would allocate it on their behalf into the real economy. Most of the time, this is very basic operations, maybe things that were like real estate projects. So we'll draw some little houses, you know, right up here. And let's say we had $3 million in the fund, and we put $1 million into each one of these houses. So because we have 3 active loans, we would essentially have, you know, 3 IOUs. Let's see if I can draw that in. Yeah, 3 IOUs. At this point, because we only had $3 million in the fund and we've allocated $1 million, $1 million, $1 million, this would mean that we're out of money. And because we're not a fractional reserve lender, you know, we cannot mint liabilities into existence, we cannot loan new money into existence, so we have to stop lending, and this is kind of what a full reserve lender in a Bitcoin world would look like, right? Not exactly. Because what we would actually do is once we originate these loans, we would take these IOUs, which are assets that we hold, and we would say, hey, these are collateral. We can use these And we can take this over to people with excess savings, with excess dollars, and say, here's a $1 million IOU. What if you only give us, say, $900,000 against that IOU and use the IOU as security for a loan? So to recap, I want to be clear here. I'm using the loan that I made to go and secure another loan so that I can make more loans. So let's kind of walk through how exactly that would work. It initially all starts with a very basic accounting entry. As soon as we make any one of these capital allocations, we make some sort of loan, we have to acknowledge that and represent that in our books and records. We have to account for that. And so there's a double entry accounting entry that is essentially made. And so what would happen here is we would have, say $1 million. And this would be leaving our account. So we would have less assets. And this is what's called a credit in accounting terms. So we would be crediting our asset account. But we have to acknowledge that we received an IOU for this, that in the future we're going to be receiving that money back. And so that is an asset to us. And so we actually have to also debit $1 million. And this increases our asset account. And so simply as a byproduct of making this transaction, of loaning this money into these real estate deals, the $1 million goes into the real economy to one of these borrowers, but we have now minted a brand new asset into existence. This asset previously did not exist. And so when you do this, and say we did this with many different IOUs, we package them all together, this is called securitization. Securitization. And so this is now a new asset that previously did not exist. And so this asset, it's not money that you can go out and spend in the real economy. You can't go and take this to Starbucks and be like, look, I have this $1 million IOU. But it does have some form of moneyness to it. It has money-like attributes. And in particular, it doesn't have money up here in the kind of normal world as we would accept it, but it does have moneyness-like characteristics in what we'll call this shadow realm. And this is kind of the basis as to where things kind of convert from the normal world into this kind of shadowy financial world. The next thing that we kind of talked about is once we have this IOU, this kind of IOU here, we have to take it to the people with excess savings and facilitate this loan. Well, there has to be some sort of intermediary that will facilitate this process on our behalf. And so this is the collateral intermediary. So down here, I'm just gonna say collateral intermediary. And so we would send these IOUs down here, and let's just represent them right here. And so the people with excess savings would send it to the collateral intermediary. We send the collateral, and then this is how we would get this money back up here, and this is money that we receive. And now that we have more money, we can go out and fund more deals. So this is a way for us to leverage our assets and get more money than we otherwise could have, even though we're full reserve and we're not fractional reserve, by using this kind of scheme right here. At this point, some people might be saying, well, this already looks like a little bit sketch. They're using IOUs to create IOUs and get more money. But really, it's just kind of getting started, because we are not the only entity in the economy that wants money from excess savings. There are other actors that say we want to speculate, or we want leverage, or we want money to go and do things in the activity or in the real economy. So maybe there is a hedge fund, HF, right here, and they say, hey, collateral intermediary, can I get some of that collateral, some of that security, so I can access excess savings? And so what they'll do is they'll pay them a fee, and the collateral intermediary will say, well, okay, we don't really have any more collateral. It's already been, used up as security, but we'll just, we'll allow you to put additional claims on this collateral. So what I'm doing here is even though this collateral has been used up, this collateral intermediary could theoretically tell the excess savings, don't worry, this hedge fund, they have the collateral. And it's almost like they're putting an additional lien, if you're familiar with real estate terms, or an additional claim against the collateral. Another way to think about it is if we're in this kind of normal world and there was a bank up here, the bank has reserves and then they're creating additional claims or fractional reserve claims out of thin air to create money. Down here, the IOU here, the collateral is kind of the money of the realm. And the collateral intermediary is kind of like the bank. They custody all of this. And they're not fractionally reserving money, but it's almost like they're fractionally reserving collateral. They're kind of giving the illusion that there's more collateral and more security in the economy in order to facilitate this excess savings for everybody else. So just to kind of recap, they pay some sort of like fee or borrowing rate, and then they would get money from excess savings, and they would go and speculate right here into the real economy. And so a lot of people will wonder, it's like, well, why doesn't this system collapse? Like this would collapse instantly. And it's like, well, not really, because maybe initially we loaned this money out at 10% interest. Because we looked at these deals and we said, these are legitimate deals in the economy. They make good cash flow or they have good valuation. But because we can recycle this collateral and we can get more money, we can continue refinancing these deals. And because we were getting more money than we otherwise would have, we actually, the more loans we do, the more money we can get, and the more supply of money means the lower we can take our interest rates. So actually, as we lend, oddly enough, we become more competitive and get access to more money. Simultaneously, this hedge fund down here is using this collateral, and the collateral intermediary is allowing them to rehypothecate it to pull out more of this excess savings from the savers and speculate in the economy. And in doing so, maybe they're buying up houses, maybe they're buying up rentals. So when we underwrite and we look at these deals, we're saying, great, we have more money, we have a lower interest rate, these valuations are going up, the numbers are looking strong, like, let's just keep the party rolling. And by doing that, we're creating more collateral and we're kind of perpetuating this entire process. And so you can see, like, in some ways, this whole shadow banking realm, like, it actually provides a valid service. Like, you do want to be able to have an incentive to pull excess savings, to pull savings from all the way down here, and you want to be able to pull it up into the real economy. And once people kind of spend and speculate in the real economy, one person's spend is another person's saving. And so this kind of creates savings, which feeds back into this loop. And so you have this kind of circular motion where it's the shadow banking sector's job to facilitate flow. And so they're not caring about like being a traditional fractional reserve bank where they're saying we're gonna create IOUs and get seniorage by creating this new form of money. They only care about flow, and the more that they can circulate the money in the economy, the faster they can circulate it in the economy, the more they can kind of charge fees and keep this game going. And again, because we're lowering the interest rate, everybody's able to kind of keep refinancing, and the game gets bigger and bigger and bigger until it explodes. You can almost think of this like this is my actual business model that I ran, but this is effectively the 2008 crisis. You could think of these as collateralized debt obligations. They get rehypothecated in the euro dollar market, and then the game perpetuates until it essentially breaks. Now, a lot of people will say this would never happen on a Bitcoin standard, but let's kind of walk through that and see if it's the case. So first and foremost, let's say that on a Bitcoin standard, nobody is accepting any sort of IOUs except for Bitcoin itself. And we'll even say that real estate is a shitcoin, because most Bitcoiners think that, and they think it's going to defund all the real estate and all of the value is going to go into Bitcoin and Bitcoin related activities. That's fine. So let's erase this here, and instead let's take some activities like Lightning Network. And then we'll also take Arc, which is another scaling solution. And we'll also take mining, if I can spell. So in Lightning Network, you need liquidity in the network, and then you can kind of route payments, and as a fee for routing payments, you receive revenue. And so a lot of people, including Nick Bhatia and other people that support the Lightning Network, say this is going to be a way to generate risk-free yield in the Lightning Network. And so maybe let's say instead of $3 million here, we have 300 Bitcoin that we're going to allocate on behalf of other investors. And we say we're going to put 100 Bitcoin into the Lightning Network, very safe, secure investment. You can't lose your Bitcoin. You can just earn routing fees. Same thing with Arc. You put a bunch of Bitcoin liquidity in there, they process a bunch of transactions, you earn the fees on it. maybe something like a Bitcoin miner. Say this Bitcoin miner has a ton of hash rate, and they say, look, based off the current hash rate, we're projecting that we're going to make 110 Bitcoin in mining fees and revenue, but we need to lock in, a futures contract with that because we need to make sure we can pay our electricity bill. So they're willing to sell that potential upside. And we say, great, we'll speculate on that. We'll buy your projected 110 Bitcoin of mining hash power, and you'll sell it to us for 100 Bitcoin. So in that scenario, these are Bitcoin only ideas. They're not real estate projects. And still, as we allocate to these projects, there would still be these IOUs that are created simply as a byproduct of double entry accounting. And so maybe these aren't dollars down here, but this is 100. Uh-oh, my pen's running out. 100 Bitcoin. And so even if you want to pretend like this doesn't happen, it does. Simply as a byproduct of double entry accounting, you've now created a new asset. You have issued this into existence. And maybe this party that is performing this allocation, it's Michael Saylor and his team, and they say, we don't want any credit or leverage, in the economy. Well, somebody else is going to come in and say, I am willing to securitize this. I am willing to put it to a collateral intermediary because I am following my financial self-interest. I want more money so I can allocate more into the Bitcoin economy, support the local Bitcoin economy, and make more money for myself. And once that happens, it's like, well, why wouldn't there be a collateral intermediary that's going to perform these rehypothecation with all this collateral? And if we're such hardcore Bitcoiners and we say, well, these are great risk-free ideas, you're going to be giving this perception to all the people with excess savings in Bitcoin that this is safe, risk-free yield. And because this is happening in the shadows, you really don't know that this rehypothecation is actually happening. You're under the kind of assumption that everybody's been making money in this game and I want to earn a little bit of yield. And so could people just hold their Bitcoin in deep cold storage and never invest it? Sure, but as much as I'm a Bitcoiner, I think that's probably the minority of people. Like, people are going to want yield. And so if you can't control 100% of the economy, this game is essentially going to perpetuate. And again, because there is because of the way this works, even if there's a fixed amount of money, we speculate into the economy. Once this becomes savings for somebody, it goes into excess savings. In Bitcoin, there's only 21 million, but then it cycles again through this process. So now, like, this whole way that we're creating leverage isn't about creating more money. It's about creating more flow. More flow is essentially what allows the leverage to persist. Okay, so let me see. The other thing that I wanted to discuss is why a lot of Bitcoiners get confused on this, why they think that this isn't actually possible on a Bitcoin standard. And it's mostly because they just don't understand it. They don't acknowledge the shadow banking system. They're not aware of how this works. They're thinking simply in this old school mindset where instead of having a fund up here, you would have some sort of bank. And if we're in this Bitcoin economy and one of these banks tries to, instead of sending Bitcoin, they try to send, some sort of IOU over into the economy. And if you're on a Bitcoin standard, somebody would be like, no, I don't want your IOU. I don't want David coin. I want the real damn Bitcoin. And the banks can no longer say, oh, well, our reserves, it's like gold and it's clunky and you don't want to haul that thing around and it will take several weeks and you can instantly settle it. So even if banks tried to issue IOUs up here, the real economy on a Bitcoin standard, the incentives would just self-regulate it out of existence. People would either refuse to accept the IOUs, or if they had the IOUs, they would just instantly redeem them. And so this kind of fractional reserve game can't grow. But we have to remember, in the shadow banking world, it's completely different incentives. Because what's happening again is as these over here, the bank can just create the IOUs and people can say no, and they can instantly redeem them. You can instantly settle it for the underlying Bitcoin. Here, this IOU is created as a byproduct of a loan or some other sort of capital allocation. So by definition, this can't be settled. It can't be redeemed for the underlying Bitcoin until the end of the loan term. And so if these are 1 year long, which really isn't even that long, if somebody receives this IOU, this securitization, this asset down here in the shadow realm, and they say, I want the underlying Bitcoin, it's like, well, sorry, man, it's locked up. You can't settle it. Sell it to somebody else, or or just wait out for the loan term to get it. But frankly, even if you could redeem it for the loan term, Nobody down in this realm is motivated to do that. They would just be hurting themselves because you're removing essentially the money and the blood of this system. And this system wants to survive. They're not going to want to eliminate more of the IOUs because then it essentially can't function. So I hope people are kind of seeing that no matter what, you can't get rid of this shadow banking system, and you can't get rid of these IOUs because they're simply a byproduct of just normal business activity. And unless you remove all sorts of capital allocation where nobody can make an equity investment in a company or nobody can make any sort of loans, that's the only way you can kind of remove or avoid these from existence. So the question now becomes, it's like, well, how do we solve this issue? And in my opinion, we have to decentralize all these financial activities. And this is somewhat what's happening in this kind of, DeFi movement on Ethereum. But now we'll be able to rebuild these applications, on Bitcoin. So let's look at like how that would essentially work. So why do we need a centralized entity here? Why do we need some sort of fund right here? Like, why can't this just be a smart contract? A smart contract. And a smart contract, the way I like to think about it is it's almost like an automated escrow company. An escrow company receives assets and money, and they have a strict set of instructions that say once you receive these assets and this money, you have to disperse these assets and this money to these people. There's specific rules that they follow. A smart contract is basically just an automated escrow agent where there's pre-programmed code that kind of says you can receive money like Bitcoin or assets, and then this is how you're going to disperse it. And so you can have something very basic where it's like, okay, here's an interest rate, and here's Bitcoin. And so you have a chart that looks like this, where it's like the more Bitcoin that enters into this smart contract, because investors are looking to lend money, the lower the interest rate becomes. Or if the more people that are borrowing from this protocol, meaning there's less Bitcoin, the higher the interest rate comes. And so it kind of self-regulates or creates this like algorithmic way to have borrowing and lending of Bitcoin in the economy. Similarly, if we need a way to recognize who owns the underlying assets in this protocol or the cash flows, and you have this kind of this new asset that's minted into existence as a byproduct of a loan transaction, well, that's just a token, That is just a token. And then over here, if somebody wanted to take this token and they wanted to use it as collateral for more excess savings, it's the same thing as here. It's just another lending contract. And if they wanted to be able to rehypothecate those claims, they could do it. You could build these smart contracts, these DeFi contracts, however you want. And the fundamental difference is that when we do it in as kind of on a blockchain or on a layer 2 scaling solution, this is no longer in the shadows. Now all of this stuff becomes transparent, and you can, at any point in time, you can audit all of the code. You can see, how much Bitcoin exists in these contracts. You can see what the interest rate is. You can see how many tokens are issued into existence. You can see how much rehypothecation has actually occurred. And because of that, now all of the actors in the economy, it's a free market. They can go and attack these protocols. In the same way, in free banking, someone like George Selchin would talk about note dueling. You can attack these kind of bad banks. But the issue with free banking, in my opinion, is information symmetry. Is not everyone had the information to know which banks are actually misbehaving or not. Here, at any given time, you have cryptographic assurance that all of this information is accurate, that we know all of the assets, all of the liabilities that exist in this system. And in theory, that means that some of these games and these schemes can exist, and they can facilitate their jobs. They can pull money from excess savings and into the economy where it's needed, but everybody has perfect information. And so I don't think that these leverage games would happen as much as they do in the shadows, where that's the kind of key problem, is when they just can fester in the shadows and nobody can see this leverage building up until it's essentially too late and it terrorizes the economy. And in that scenario, if we were on a Bitcoin standard and we didn't have these kind of smart contract setups, then you essentially are giving leeway for politicians to come in and be like, see, we told you, a Bitcoin standard would fail, everybody is starving, and we need to now institute a central bank and a fiat currency again. So you can't just have fixed money. You have to acknowledge that these financial applications will exist. Really quickly, I'll kind of describe why I'm more excited about solving this problem now than ever. Like up until recently, a lot of people would either just kind of ignore this and pretend like this isn't an issue, or they would say, oh, these financial apps, these DeFi apps, like we can just build it on Lightning Network or whatever. And that really wasn't the case. It's just code, because you either couldn't build these types of applications, or you would have to do it in such a clunky and inefficient way where they can't actually outcompete these centralized shadow banking alternatives. And that's ultimately the battle, is not only adding the functionality to Bitcoin layers, but doing it in a way where they can compete at the very highest of levels. So this is a very high level of essentially what every single Bitcoin layer 2 looks like. It's just Bitcoin right here with the 21 million. It's some layer 2, scaling solution, and then it's, apps right here, some sort of features or apps that it does. If we just took some high level analysis, because this is not meant to be a technical video, it's mostly focused on the money, but I just want to explain this to people, is that if you have something like Lightning Network, Lightning Network, it can only do payments. Like it can't do these kind of fully expressive smart contracts. It can't freely issue tokens. I know we have Taproot assets, but it doesn't have a global state. It doesn't have the full level of expressivity. It's kind of just being able to send money back and forth. So you really can't build it on Lightning. Same thing with something like Arc. Arc is just meant to do payments, so you can't do that type of stuff. Maybe somebody would say, well, what about, RGB, or what about Fedimint? Well, with both of those solutions, you don't actually solve what's called the trustless two-way peg, meaning Bitcoin that you move into the layer 2, you're trusting some sort of entity, you're receiving some sort of derivative IOU type of Bitcoin. In order to bridge it back into the Bitcoin L1, there's potentially a centralized party, or there's some level of trust there. And so if you have that, people are going to be less incentivized to bring liquidity into that L2. And if there is less liquidity, then you won't get as good of pricing. And so again, you won't be able to compete against this shadow banking system. Additionally, on some of those projects like RGB and Fedimint, a lot of those are kind of like bifurcated, or they're kind of like siloed systems. So you have different mints that can all try to interact with each other, but essentially they're isolated little instances of each other. And because of that, there's friction of kind of interaction between all these different mints. So you're fragmenting liquidity, which again, either adds costs or adds inefficiencies, which wouldn't allow you to kind of compete against the shadow banking system. The final solution, which is the one that I've mentioned, that I did another whiteboard video, and that I think is a kind of profound breakthrough for Bitcoin, is something like ZK Rollups. With ZK Rollups, we could solve this peg right here, where there's no trusted intermediary to kind of go between Bitcoin layer 1 and the layer 2. That means you give people the greatest assurance and comfort to bring the maximum amount of liquidity, huge swaths, billions of dollars of liquidity into the network. Additionally, you can trustlessly interact between the different instances of a ZK rollup. And so that reduces the friction and lowers it the most, and kind of increases the amount of cost savings and the cross composability, and gives you like the absolute best pristine environment you want to be able to recreate these applications in this transparent manner. I'll also say with ZK Rollups is you could use any programming language, any execution environment you want. For developers, that means they're no longer confined. It means that if you can logically think through it, you can build it. And so I think that pretty much covers all of it. But the takeaways I want for people is people to kind of understand, and feel free to even challenge me on this, is that how can we get to a Bitcoin standard where this doesn't exist, where these financial actors cannot create this leverage in this shadow banking scheme? For as long as I thought about it, I don't think it's possible. So that's why I've kind of converted myself from being a monetary maximalist, where I kind of come from this Austrian background where I say, 21 million Bitcoins is all that matters, and we just need to be able to send it really back and forth fast to each other, and once the fiat debt bubble busts, like everything is just going to be safe, to kind of now I've become this platform maximalist where I recognize, like, okay, if we want this monetary revolution to succeed, we're also going to need the technology revolution to succeed, because the technology revolution in combination with the monetary revolution is what's going to outcompete this true kind of shadowy system. So I think that's pretty much everything. Hopefully that makes sense. Leave some questions and comments, and yeah.